All right. Welcome, everyone, to the second seminar series. We're very excited today to have Jason Fleming and Daphne Che join us. Thank you both for being here. We're really excited about this particular session because, of course, when capital gets more expensive, the big question is, what is the right way to raise and manage capital? It's a super hot topic, especially over the last year or two in D2C, given there's been so many structural changes and so many both economic and I guess platform have caused so many changes. And so we're really excited to have this conversation with both of you having varying perspectives on this question. So I'll give a quick intro on me. I'm one of the co-founders and CEO here at Fermat, but you guys are the main show. So Jason, would love for you to give a quick intro on you, and then Daphne will send it over to you.
Yeah, thanks, Rishabh. Thanks for having me. Thank you, everybody, for tuning in. My name is Jason Fleming. I am the head of revenue at 8Fig. That's the number 8, FIG. We are a startup company ourselves, like probably many of you on this stream. We are a funding and growth platform specifically for e-commerce brands and resellers. We are venture backed, and essentially what we do is we sell money and we sell working capital, and we provide a funding and growth platform for e-commerce brands and resellers. Most of our clients are going to be very active on Amazon or Shopify, sometimes both, sometimes some other platforms. They're going to be D2C companies in many, many different product categories. And essentially why we exist is to provide capital to those e-com brands and resellers. I myself am the head of revenue, so I head up the sales function and our customer success function based out of our Austin, Texas office. And then we've got about 3/4 of the company located overseas in Tel Aviv, Israel. Most of our engineering team, our risk analyst team, most of our C-suite's located over there. But most of our customers happen to be in the United States or globally. So we're very, very excited to really dip our toes into this space. We've been around for a few years now. Growth is picking up. We see a lot of demand out there for our product, and hopefully we can share some valuable insights with you guys today.
Awesome. I'm excited to hear more, man. Daphne, over to you. Can you give a quick intro?
Yeah, happy to. Good to be here. My name is Daphne Che, and I am a principal at Montage Ventures. We are an early stage VC fund based here in Menlo Park, and I lead our commerce investment arm here in Montage. We're lucky to partner with Fermat at the C stage and seeing they grow in the past year and a half now. And yeah, like I said, excited to be here. I'm going to try to be helpful, provide my perspective from an investor point of view, and especially at the earliest stage, we're deploying capital at the seed and Series A.
Amazing. So I guess I'll kick us off with the first question. Jason, you just mentioned you're starting to see a pickup in demand again for people asking for various types of capital. And so one of the things I was curious about is timing. When you say picking up again, what do you think about when it comes to like when is the right time to raise the type of capital that you guys provide? What are either the factors in the market or the factors that should be true about the business? And maybe you can start even a step further back than that by just laying out the different types of capital that you guys do provide, so that way we have context on how somebody should think about, you know, when is the right time to seek capital from a provider like you?
Sure. Yeah. So most of my background, I've been in fintech for most of my professional career. And really, as soon as I started back in the early part of the last decade, I would call that there was sort of fintech lending 1.0. And could you get businesses, SMBs, sometimes larger companies, but a lot of times SMBs, could you get them to borrow money online? That was sort of the 1.0 version of sort of that fintech lending wave. And so I would lend to a company, I would lend to a restaurant, a nail salon, a construction company, an e-commerce business, and a doctor's office all on the same day. And there was no verticalization of the market. It was really, could you get these companies to borrow money online with relatively very little in product differentiation? And then Amazon Capital came online, Shopify Capital came online, and Clearco came online, a few other companies came online. either right before the pandemic or during that real online shopping boom near the beginning of the pandemic, when the capital markets environment was very different. So I think the long-term secular story is that there's just more specialization now, and there's going to be a lot more specialization a year, 5, 10 years from now than there is today. It's not going to be the case where you're going to find lenders lending to all the variety of different types of businesses that they used to lend to 10 years ago, all in the same day. There's going to be product built for specific verticals. Right now, there's fairly decent spread and breadth of companies that are focused on funding e-commerce businesses. They evaluate the businesses through a certain lens. Everybody's perception of risk is different. But speaking for 8Fig, we're trying to solve for a fundamental problem that most e-com brands have, which is they have to typically deploy capital before they receive inventory and have an opportunity to turn that inventory back into cash. And that is pretty much a universal situation for most, at least emerging e-com brands, if not even ones that have been around for several years. So that's why they're looking for capital, is because they're trying to solve for that particular and that's not necessarily something that's tied to the most recent business cycle or a higher interest rate environment. And I think what you have seen is some shakeout in the e-com funding space, where it was very hot a couple of years ago, and it was more growth oriented rather than profitability oriented for these platforms. And so we've just seen sort of confluence of a couple of different factors, a long-term trend, a short-term trend kind of coming together, and just more people shopping online, more people doing business online. I think we're going to continue to see more of the same. And I think it's opportune for the e-com brand, because the products and the fit is going to get better and better and better. So that's really the trends that I've been seeing lately.
Got it. I'm going to push on you a little bit. Don't you think a little bit is also driven by sentiment since the start of this year in particular is actually better than last year? So at least something that we've been seeing is that last year people were unsure how to interact with the higher interest rates, unsure what the right way to deploy capital would be. And then something shifted. I think consumer sentiment was better. Inflation looked like it was, I mean, well, who knows with the most recent print, but and I'm not a macro guy, but people were more optimistic. The stock market therefore went up, specifically Facebook and Shopify stock going up those are good reflections of general sentiment in e-commerce. Do you not feel like macro is helping to some extent here, or how should merchants be thinking about it with respect to consumer sentiment, consumer demand, and people's willingness to shop online?
I do agree. I think consumer sentiment is, broadly speaking, supportive now of increased demand for the merchants, for the brands. At a time, maybe 18 months ago, when the only thing that you could see in the news was supply chain issues. The merchants, the brands themselves, had a much different feeling about that. But I think as those supply chains have repaired, interest rates are still high. We thought there would be some cuts, but there probably are going to be some cuts this year, but I think that's anyone's guess at this point. Inflation is lower, certainly, but it is sticking maybe a little hotter than the Fed would like. But at the end of the day, if you're looking at consumer sentiment, unemployment is low, consumer balance sheets are okay, and demand seems to be high. So that's probably driving some of the demand that we've been seeing. And then you overlay that on top of sort of this long-term secular trend where it was very bubbly and very frothy in about summer 2021. And so you have these kind of countervailing forces that are acting in concert. But I think, as it all shakes out, I think you're definitely seeing consumer demand, at least as healthy as you would kind of expect it, and more resilient than maybe you would have expected with rates going up so much in the last year.
Yeah, that makes a ton of sense. What about on the venture funding side, Daphne? When do you think is the right time for somebody to raise venture financing for build? I know seed stage is very different than Series A, so maybe you can talk about those two things separately, and especially in the context of the current market. I don't actually know how active you are on X, or formerly known as Twitter, but there is a lot of chatter in the online world about merchants' feelings about raising venture capital. And so maybe you can just share from your point of view, when is the right time and what is the right shape of business? Personally, I think that venture is like a very useful, look, I'm biased. I've raised venture capital, but I think it's a very useful instrument. And so maybe you can just help shed some light on how D2C merchants can think about it.
Yeah, happy to. And I think I can even try to be more specific in that my answer would be relevant to C-stage companies in the e-commerce space, because we also invest in other category as well. And Rishabh, to your point, right? Venture capital is a class of capital in itself, and you can even dissect into, okay, is it angel, C, Series A, B, C, and all that. So to be clear, I am on the seed stage. So the quick answer to the question, when is the best time to fundraise? People might have different answer. But my answer, I think is you always fundraise. As a CEO, I think one of the major responsibilities of the CEO is to make sure the business that you stay in business, that you keep an eye on cash flow, and so that to make sure that you always have conversation, always think about how to fundraise. So I say always, you should always at least have a strategy in thinking about when or how I should approach financing. Yeah, that would be the short answer. Now we can dive into, for the C stage, for e-commerce direct to consumer, what we're looking for whenever we talk to new opportunities. We will look for companies that have healthy runway. You don't want to go in and tell investors that I'm going out of business in 2 months. I have 2 months of runway. Help support me. It's always about growth. It's the investor want to invest in a company that's going up. Right. So that's the story that you want to convey. I would suggest a minimum of 6 to 12 months of runway that when you come out to fundraise, the more the better. And also have a growth story around it. I know we're going to have a conversation around growth versus the runway or later, and we can talk more about that. But again, if you think about investor point of view, they want to grow, and VC, we have the mandate to at least 10x our investments. That's our mandate. So you need to make sure that you come in with a strong story to convince the investor that we're really going up into the right here.
How should a merchant think about who is the right partner for them? So, like, what are the things that you would suggest? First, Daphne, and then Jason. I'm very curious from your point of view on inventory financing. I've had the good fortune of meeting a bunch of other people on your team who have talked to me a bunch about the differentiation that 8Fig has specifically relative to other potential lending options. But maybe we can start with Daphne first. How should somebody think about who is the right partner to have, right? Like, I guess, like, you can, why not take this opportunity to say, like, why Montage? But also just, like, in general, what criteria would you suggest, right? So when you're advising companies who is already part of the portfolio, what are the things that you're telling them to look for in a partner?
Yeah, I say, first of all, they should have a process, and they should know they should have a target list in general. These days fairly easy, like you mentioned, Twitter or X, or even the fund website, to find out what stage they focus on, to find out which partners or which investment professional focus on which sectors, to make sure that it's relevant to your company, it's relevant to your stage. That's the first thing, because I've been approached by inbound messages where it's totally off focus. I am a commerce person. I wouldn't invest in a medical device, for example, or I would invest in a Series C. So make sure that you do your homework first and do that check mark. So first, make sure there's a fit, and then there's a personal fit, because VC, I think, is a long-term relationship. You want to be in a good relationship with this person. Think of it at least 5 to 10 years. 5 is a very good scenario, but average 5 to 10 years relationship here. And because when you're building a company, the last thing you want is some falling out with your investors. That can be very distracting. So make sure that you have this connection, professional connection, but also personal connection with this person as well.
Yeah, that's super helpful. Jason, I've got to put a little twist into my question and ask, should people be taking TikTok financing for inventory financing. I'm sure you saw the news, but I guess like when you're thinking about how are the different ways that people should think about their inventory financing, how should people be thinking about it? And given the recent news, I'd be curious to get your perspective on that too.
It's no surprise to me that TikTok is getting involved in that. There is a natural sort of confluence of several different factors there. Platforms want to be fintechs. Fintechs want to have access to the data. So if you have access to both, there's a natural overlap there. When Amazon Capital and Shopify Capital started, it was so obvious that was something that they would want to do because they have the data, the sort of natively there already. 8Fig, we're more of a pure play. We're really there to provide the financing to the e-com brand. One of the things that I like to tell our customers is, at the end of the day, if we don't sell the money, we don't make money. And so we're going to try to make our offers as attractive and as tailored to your particular business as we possibly can. If you're evaluating an offer or looking at financing options from somebody that's maybe less of a pure play, like a Shopify or an Amazon or maybe TikTok in the next several months, you might not have that level of sort of tailoring to your business. And so tying that back to sort of the bigger picture question in terms of what we do and the type of financing that we provide, where do you need to be? What should you be looking for? I think this goes for any line of business, but if you're trying to build a brand, have a laser clear vision of the type of brand you want to be. If you want to work with Daphne and be VC backed, she mentioned it herself, they're looking for 10x minimum. That comes with a certain size that you want to be or have a plan to be in the future. If you want to run a couple different product SKUs and make money and grow at 5 to 10% year over year, maybe experiment once in a while with a new product introduction, that would be a great success story for a lot of people. That's probably not a VC-backed company, but it might be a company that we would want to work with. And so just have a laser clear vision of how much time and energy and effort you're willing to put into this thing and what you truly want to be. That's really the first thing. Think about other factors. Are you purely D2C right now? Do you want to get into the big box retailers? Are you a hybrid right now? Those types of businesses tend to be financed very differently. So if you're going to stick to D2C, you're probably looking at a certain type of financing option. If you're already B2B or you're going to be hybrid in the future, you might be looking at different types of financing options. So there's a size component, there's a sales channel component to this. And just be brutally honest with yourself about the things that you are and that you want to be. And I think ultimately companies like 8Fig, what we're trying to solve for is that working capital cash flow gap that just many, many brands have. And if you're not super well capitalized because you earned a bunch of money somewhere else and you poured it into your new brand, that doesn't mean you can't make a go of it. I have plenty of clients that are very, very successful who were thinly capitalized, but got their unit economics really dialed in, understood their product categories very well, had great content, great landing pages, great conversion funnel, great retargeting, really understand their ad spend, really understands the market, and can make money for a long time, maybe not growing super fast, but can really understand those challenges. So it's very doable. We work with companies that are VC backed, but they're certainly not the majority. And so, just have a crystal clear vision of where you're at and what you're trying to be. And that'll get you 80% of the way there. The other 20% is sort of the details and talking to enough different funding companies and looking at contracts and having good people internally that can give you good advice on what direction you need to go in.
Jason, maybe I'll just continue from there. What are the types of companies that you gave like a pretty broad spectrum, right? So it's like in terms of inventory financing, it's everybody from like those who are trying to 10x to those who are just like, hey, this is like a steady, quote unquote cash cow business. And it's like a healthy way to just continue to finance the inventory. How would you what is the archetype of the type of companies that are getting funded from a platform like yours versus the type of companies that would not get funded from a platform like yours? Just so that way, again, people have a good framework for like, hey, these are the types of companies for which we are a good fit for actually getting inventory and cash flow financing versus these are the types that are not a good fit.
Sure. So 8Fig follows a revenue-based financing model. So there needs to be some minimum level of revenue that you're generating on Shopify or Amazon, a couple of other platforms that we integrate with. Most of our customers are going to be brands that are doing, or resellers that are doing anywhere from a few $100,000 a year to $30 million a year. $50 million a year would be a very, very large brand by 8Fig standards. 8Fig, just opening the kimono a little bit, is short for 8 figures. So ultimately, our goal is to help merchants that are doing 8 figures in sales. More realistically, help companies that are doing 6 and 7 figure annually in sales become 8 figure seller brands. Now, if you go from 8 figures to 9 figures, you're probably more in Daphne's ballpark potentially, and the financing options are our ability to help finance your business might be a little bit limited if you get too big for us. So that's who we tend to help. That tends to be the bulk of the market, at least on a unit basis. And so we've been very successful, still making mistakes and still learning as we go every single day. But those tend to be the customers that we're helping right now, or so there's some traction emerging. Now, if they want to become a huge brand, we can still help them because there's certain revenue characteristics that they're not meeting yet, but maybe before they continue to raise additional VC. Or if they want to run it as more of a lifestyle business, they really understand the unit economics on a fewer amount of SKUs. They don't want to spend and they don't want to invest and make a lot of speculative investments on R&D and new product introductions because that's outside of their risk tolerance or outside of their comfort zone. Perfectly happy to help capitalize those businesses as well. The common characteristic is that they tend to have a working capital gap. As just kind of hammering that point home, is they have to deploy capital before they get inventory, and that's the gap that we're consistently trying to help these merchants bridge over, and turning that reality for most e-com brands hopefully into a source of competitive advantage. Because they get phone money. It's not free, certainly. And so one thing I tell merchants is, listen, your competitors are in the same boat that you are. The company that wins in this category is likely going to be the one that's financed, not necessarily with the most dollars, but in the best structure for your particular business. And then you can kind of use that as a source of competitive advantage and hopefully box out some of your competitors in your particular categories.
That makes a ton of sense.
Yeah.
Daphne, I was curious, the venture market seems to have cooled off on e-com and D2C. And not speaking specifically about Montage, I'm just curious, in general in the ecosystem, what are you seeing in terms of who are the types of companies that are actually receiving venture funding now on a continuous basis from the venture industry in D2C e-com versus the types of companies that are not? And I mean, I think both you and Jason have made it very clear. It's like, hey, if you're a steady state, sort of slow growth, that's like a very good indicator that it's not a good fit for venture. What are some of the things that may be non-obvious to people about characteristics of what the current market is looking for?
Yeah, happy to answer. And I want to caveat that each fund might have different mandates. So the answer that you get from another seed fund, even like e-commerce focused seed fund, might be different than mine. So I don't want to generalize it too much, but I'll try. I'll try my best. In that, your comment about fundraising has been tough is true. It's across all categories, especially direct to consumer and especially in e-commerce overall for certain reasons, as we already see. And I can count. I think that would kind of answer your question too. And these days, direct consumer is tougher than the peak in 2021, where the CAC to LTV ratio, especially if you only do direct to consumer, is a lot tougher than it was a few years ago. So that kind of math is making company burning too much money, right? And it just make an investor become scared when they see company just burning money. And so that's one reason why it's sort of like a red flag where we keep seeing the burn without seeing the growth. So that's one. Another one that also in general, as investor early stage, because we invest so early, and Jason actually maybe earlier than what you said, because we have invested in pre-revenue companies too. So for us to sort of like model out our exit potential, we usually use public comp. And public comp for e-commerce and D2C brands mostly have been struggling really. So that's reflect also in our math when we projecting out, okay, because when we invest, we're going to be able to see this brand. Do we see them getting to 100 million in revenue in 5 years? That's like our ideal scenario. Shorter is better, but we want to be able to see that path, and just getting harder. And that's, I think, is the main reason, or are the main reasons why we've been pulling back. And I think in general, there are capitals out there in the VC world. People are just pulling back because they want to, seeing more stability in the macro trend. We have election coming up here. Jason, to your point earlier, inflation and interest rate. We want to see more stability before we deploy capital. So people are holding back. Not necessarily that they don't have money to invest; they're just holding back. Did I answer your question?
One thing I'm going to push on you a little bit, because one thing that I've heard a lot of investors say is actually that there is venture money that wants to go into D2C e-com. It's just that the price has not corrected. So I've actually heard this from a fair number of people at this point who I respect quite a lot, that the issue is not actually the availability of funding in the venture industry. It's actually just that calibration on what is the right price for that funding, it has not calibrated. And that's actually the core reason why there's a disconnect in the market. How would you react to that statement?
I think it's also true. I think there's two camps here. One, there are funds that are just saying no to consumer. They've walked away on a macro. Right? It doesn't matter your metrics. If it's a consumer, in fact, there are funds that their origin was consumer, but now they completely walked away, doing more B2B, for example. So that's the first camp. I guess I was talking a little bit more about that. And second, yes, you're right. There are still, I think, founders need to recalibrate because, again, we have this 2021, 2022 peak of valuation. Now that those comps no longer relevant anymore, really, in this market. So those need to be adjusted. So yes, that's true too.
Yeah, makes a ton of sense.
I'd like to offer a theory there, actually. As I'm a consumer brand, maybe a CPG brand, maybe pure D2C, and I'm raising VC. I'm not one of these people, but if I were a CEO of one of these companies and I was raising VC, I might say, well, I never got a tech multiple in the first place. So why does my valuation have to come down compared to where all the froth was in SaaS and fintech, 2-3 years ago? I never got a tech multiple for being a consumer product. So why should my valuation come down concurrently with the rest of the market? That might be my natural reaction, is something that I would think. You might encounter some resistance that way.
Oh yeah, I would agree. I think what Rasham and I were talking about was the D2C valuation that were frothy, just as frothy as fintech, the multiple you looked at. So that's what we meant. Yeah.
Gotcha.
Yeah, it was. Yeah, it's interesting because and I'm happy to share my own experience, but we just did a financing round for our business, and I will say, I went into the fundraising with a reset set of expectations for what is a reasonable valuation for a company at our stage. Now, we got a great round done and I'm very thankful for it. But I think that price sensitive, again, it depends on what type of business you're building. If you want to own 100% of the business and then take distribution on the profits, then you should run that type of business. That is an amazing life to live. But if you're trying to just grow a business to be as fast as possible, and your goal is asset value creation in order to sell that asset at some point, then you need to think about okay, how do I finance that, and what is a reasonable price to finance it at, and how do I make sure that I can actually just stay in the game long enough to do that. Anyway, that's just my perspective, but I can understand and appreciate that people dislike when prices go down. So that's perfectly reasonable. Yeah. All right, man. I want to switch to the next topic. which is really to talk more about mindfully managing your money once you raise it and how to think about the management of the money. And Jason, I want to start with you because you guys actually do inventory financing. And so I guess one of my questions is, when brands come to you, especially because you said you start at like 500K, like six-figure brands, I can't imagine it's easy to be mature about how you do your planning and forecasting when they, like at that, if you're just starting off, it's one or two people, there's like 100 other things you have going on. And so how do you think about the maturity of that dimension? Do you guys help with that dimension when people come to you saying like, hey, I think I need inventory financing? And is this something, how should somebody think about the management of their money? At what point should they have what maturity level? And do platforms like yours help them with those types of questions?
Yeah, so I'm very happy to report that is something that is getting better. I'm unhappy to report that the bar was so low to begin with that it really had nowhere to go but up. So to the extent that these brands, especially these emerging brands, six-figure brands, it's usually a one, two man or woman show. They are wearing many, many different hats, and I have all the sympathy in the world for the hats that they have to wear. And financial reporting and financial controls, having those proper systems put in place can be put on the back burner, sometimes by necessity, but sometimes completely out of just they don't know how to use the tools out there. For one, they weren't readily available 3, 4, 5 years ago or more. The availability of those types of products to help you put in the proper financial controls of your business have vastly improved. They're improving at an extremely rapid clip. Literally every single day, they're getting better and better. So one thing that we have added as sort of a value add to our merchants and the brands that are working with 8Fig in terms of getting their funding from us are cash flow management tools, inventory management tools. And I was skeptical of how powerful these tools could be myself when I saw them demoed internally, because I figured, well, you'd still need an accounting background or at least a very, very good bookkeeping background even to do a lot of this stuff. And as it turns out, with a lot of the advancements in AI and a lot of the advancements in the connectivity of certain data, various data platforms that you might be working throughout your technology stack, it's getting, I'm not saying it's not trivially easy, but it's easy. It's easier now, and it's getting easier and easier every single day. The trade back would be is if you're not jumping on top of these tools as an emerging brand, you are falling behind. So it's something that you need to get on top of sooner in your life cycle rather than later. If your mental model of your brand is still what's in my bank account, or or Excel, or it's looking at my cash balance and my checking account, that's a problem. You need to have a more sophisticated understanding of how your ads are performing, how much inventory that you need to have on hand. When do you start a new order with your co-man? Are you getting the types of products and the quality of products in a timely fashion from your co-man? I mean, this stuff is all money at the end of the day. It's reflective of cash in and cash out of the business, and having a very, very well-controlled cash conversion cycle that you're constantly iterating to improve upon is something that is mission critical for these brands. And the sooner you can have those tools in place, the better. I'm happy to report that 8Fig has a lot of these tools available for our merchants. They're getting better all the time. They're certainly not the only options that are out there. So do your research, and the sooner you can get a handle on that stuff, the better brand you're going to be. Again, use it as a source of competitive advantage. The way I said that most of these brands are having to deploy capital before their inventory, they get their hands on the inventory. It's the same thing with proper financial controls and reporting. If you're a six-figure seller, sort of an emerging brand, you're starting to get your name out there, starting to get some sales out there. The sooner you can adopt the right habits and have the right tech stack in place to really understand how your business is performing and where the shortfalls and where the gaps might emerge, the better off you're going to be. And you can start to use that to nudge out your competitors in the categories that you want to be leaders in. So the tools aren't great yet, potentially. They might be a little bit difficult for the one or two woman show, man or woman show to really operate themselves, but they are getting better and better all the time. So start learning about it, because it's going to be very, very powerful. It's going to be table stakes in the next 12 months too. So you got to get on this stuff sooner rather than later.
Yeah, My 2 cents is I totally agree. It's funny, for our business, I was encouraged by a different investor to hire a head of finance sooner rather than later at a certain stage at our company. And that was one of the best decisions we ever made, because now as the CEO, I can like see the levers emerging of, okay, like here's what my CAC is, here's what it is as a percentage of the first year revenue, here's what, you know what I mean? And you can just understand where to invest and what, and I'll take us to our second question in this domain, how to think about like, how much do I want to invest in growth versus like profitability, essentially. So Daphne, I'm wondering from your standpoint, you said like, hey, we're here to invest in the growth brands. And so when somebody says that, it's like, okay, but also not growth at all costs, right? And so like, what is the simplest way for somebody to think about that trade? But and simple meaning like, what are some good heuristics for how somebody should think about the trade between, as a D2C brand in particular, between growth and profitability?
Yeah, well, maybe let me caveat first. Then I am aware that as VC, as investors, we're asking for unicorns. We're asking for a company who have lots of runways, company who grow, 100, 200% year over year. That we do love to see that. But I am aware that this also is an environment that is really tough. So to answer your question, ideally, I think. Ideally, I think that profitability should be tied to growth. What I meant is that I have seen portfolio companies in the DTC that are growing profitably, and then the way they do that is that they really have a tight ship on the ROI. Like any growth investment that they put in, they usually have a clear ROI or a target. Now, it could be marketing. That's fine too. But as long as they're very clear that, okay, this investment is for marketing, for brand awareness. Now, there's this experiment that I do on Facebook or any channel or podcast or newsletter. I'll put in this money, and then I will continue to grow, put in investing in that channel if I see the ROI, and I'll stop. So those are some of the things that I've seen worked with our portfolio companies. So there's no there's no straightforward answer to this one. But I think that in this environment, and to our point earlier, it's a tough fundraising environment. I think runway is your strongest advantage. So if you have to pull back growth in order to get to profitability earlier, to extend your runway, I think I would lean toward that. And my answer, if this question was asked 4 years ago, my answer would be different. I would say leaning toward growth. But right now, I say if you have to choose, I do think profitability, unless your growth, you can see the clear ROI. Like, hey, you put in $1, I'm making back X dollar in terms of the return on investment. And then yes, we should go for it.
So can I ask, and this might be a tenuous or like an impossible question to answer, but isn't there ultimately a point at which either you need to decide whether you become default fundable or default alive? And you can't actually, so I'll give you an illustrative example. Let's just say you like can extend your runway like a very large amount, but your growth rate starts to go into the 20% if you do that, which means you're no longer default fundable. Or you shorten your runway, but you can start to grow like doubling year over year. But now it's like, if I don't raise capital in a year, then the business is going to die. So in the one case, you're like guaranteeing that you cannot raise money because you've reduced your growth rate, or like, how would you suggest that a CEO think about it, basically, if that's like the decision that you're faced with?
In fact, we do have portfolio companies who are in both of those, different companies who are in, they have chosen their path. And I think in this case, my advice would say, let's go for the long, let's go a little bit safer. Because if you can survive this, I think this is a little bit up and down right now, where sort of like at the bottom a little bit, it's hard. So if you can get over this period and you have a chance to invest back in growth. This is not permanent. This is not like just stop investing in growth, but this is, let's make sure that you can stay long enough to see your competitors going by the sideway and capture market share. There could be opportunities, but I would also say that it depends really largely on the companies. My advice isn't always like this, but I say if I were to give this one to a lot of people that I might not know the true story, I want to be giving a safe answer, versus if I know more, like if my portfolio company does certain things, then yeah, we might push for the growth. But yeah, I'm being safe here.
Yeah, makes total sense. And Jason, I'm just curious from your seat, when you see people, a lot of brands, there's two things they need to invest in before they make revenue. One is inventory, the other one is marketing, right? And so the marketing side is directly tied to growth. Both are directly tied to growth. And you can correct me if this is incorrect. It sounds like you guys are more focused on the inventory side. But when you are talking to these merchants, ultimately you're looking at the whole equation to see how the math works for the business. And so how involved do you guys get, or how do you think about like what is healthy in terms of how they should manage for investment in inventory versus, I guess, direct growth marketing? And what do you see as like the healthy mix for the types of merchants that you guys are working with across the spectrum?
Yeah, our most successful merchants have, usually they're deploying our capital into inventory and marketing. What I would say the smartest and the most successful merchants that brands that we work with don't take speculative bets with impatient capital. And I know it's kind of pejorative, but I would consider 8Fig to be fairly impatient capital. I would consider all of our competitors to be fairly impatient capital. 8Fig is really designed to finance your working capital, your cash conversion cycle, and the gaps that might exist in that cash conversion cycle. We expect as the inventory turns back into cash, that we get paid back more or less roughly in that cycle. So if you're a brand that needs to invest in aggressive marketing or product development or new product introduction, that's going to take a long time to pay off, you're going to need patient capital that maybe 8Fig and some of our competitors aren't really the best fit for. Maybe VC, maybe SBA lending, bank financing. It can be very, very difficult to get because banks don't typically like e-commerce businesses very much. Or just you're well capitalized and you can afford. You're well capitalized because whatever you had when you bought and started the brand, you still have that capital, and you can afford to be a little bit more experimental and a little bit more speculative. So our most successful merchants have a well-defined inventory cycle. They know their categories. They know their pricing very well. They have a very good relationship, a reliable relationship with their co-manufacturer. And they understand how this inventory is going to turn over. And really this time to bridge those gaps so they can do more and move faster and maybe free up some capital to maybe invest in some more speculative areas. Because that's what's going to drive the long-term value of the company in a lot of cases. If they are looking to be that 10x, 100x type company, do 8 figures in sales, 9 figures in sales. So be very, very honest about yourself. And there's plenty of smaller brands out there that are trying to borrow money from companies like 8Fig and our competitors who are simply trying to kick the can down the road. So another piece of advice I would give is be ruthless about cutting bad expenses and bad investments. I know you thought that category or that product was going to be a home run, and it's a bunt single at best, and you're not making money on it. You have to be brutally honest with yourself that maybe this is the category that I want to cut. Or this is a product that I want to cut, or maybe I'm overstaffed, or maybe I'm spending way too much with my marketing agency and getting far too low of a return. So if you're using funding, kind of 8Fig funding and sort of fintech lending to paper over making the tough decisions, or maybe just trying to buy some time on something that you really, really believe in and you think you just need more time to turn it around, I'm not here to tell you not to do that. But just be brutally honest with yourself about why you're trying to borrow money from a company. Are you actually trying to bridge your cash flow gaps and free up capital so you can be more resilient in the long run? Or are you maybe kicking the can on some tough decisions that really you ought to be making sooner rather than later? And then if you are in a position where you want to experiment and want to make maybe more speculative investments and trying to be, on home runs on new product introductions, you're probably looking for more patient capital than maybe what 8Fig and some of our competitors offer. So be very, very cognizant of that. Is how fast do I have to pay the money back? Do I have to pay the money back at all? If I do, how long do I have to pay? How long do I have to take to pay the money back? Because that's going to really dictate what you're going to be able to use the funds for.
Yeah, that makes a ton of sense. While we're on the topic, you were talking earlier about like, hey, the best companies are deploying it a little bit into inventory, a little bit into growth, and have a really good handle on exactly how that capital. I mean, what you were saying just now, which is, hey, it is really for cash conversion cycle, and so they really understand the economics of their business, the unit economics of the business, what type of investment they are making, whether it is short term or longer term. If you were to just very quickly summarize, what are some of the characteristics of the best companies and some of the common mistakes you see people making? How would you characterize those two camps? And then Daphne, I want to hear your response to that question as well.
Yeah, even if they don't have a sort of an accountant or a CFO's level understanding of why their products are working and make them money, and are growing at the clip that they're growing at, they have an intuitive sense because they're product people. That's usually most of our founders are going to be product people. Product marketers and product developers really tends to be the focus, tends to be the types of founders that we tend to work with. And that makes sense. If I'm selling a physical good, I'm probably more passionate about, the product than I am about the financials underpinning that product when I started the brand in the first place. And so they have an intuitive sense, at least, that, hey, I really know the widget business. I understand how to make a widget ad work for me. And maybe I can't give you an audited financial statement that I would know how to put together to tell you how successful my business is. They know widgets. And so they're selling their widgets and they're making money. And they understand they have cash conversion cycle issues. And so they take money from 8Fig and they invest it maybe 80-90% into inventory and 10 to 20% into logistics, marketing, and shipping. And they really have at least that intuitive sense that this is something that's going to work for them. And they don't make speculative bets. Like, I'm the expert. I know the widget business very well. I can sell widgets and I know how to market widgets. I don't necessarily know how to market and sell doohickeys. And now I want to take this money and get into the doohickey business. That's where you can see some of the foul ups, the trip ups that some of our merchants get are sort of those speculative investments where they're the widget master, they're not the doohickey master, and they make investments in the doohickey business that don't tend to work out. So what we tend to invest, or we tend to tell our merchants and try to coach them in is, listen, new products are great. It's something that's super fun. And if you're going to become a big brand, you're going to have to introduce new products over the long run. We're totally behind that. Can you start? What's your budget for getting into the doohickey business? Okay, can you do it with 50% or 25% or 10% of that budgeted amount? Get some data on how well you're going to be performing in the doohickey business before you really double and triple down on it.
Yeah.
And if that's the case, those are going to tend to be the most successful merchants that we work with and are good stewards of their capital that they get from us.
Yeah, Daphne, what about you? What are some of the behaviors you see or some of the activities you see from the most successful brands? And then what are the common mistakes that you see?
Yeah, and I think I can answer the first part, and then the second would be the opposite of what I answered. So I think especially for direct to consumer, knowing your metrics really, really well, and there are vanity metrics, ARR, GMV, but I think for e-commerce, especially direct to consumer, your CAC, your contribution margin, your cash flow, your gross margin, your COGS, all of that, you need to make sure that you really understand very well. And then another level, I kind of mentioned earlier, and I see some of my most successful founders in the e-commerce space, they also know exactly what's the ROI for each of their channel. How much they're deploying and what cadence they're deploying and when to stop as well. So I think that would be one thing that if I have to say just one. And the opposite of that, of course, would be chasing after vanity metric, would be not really knowing what's your CAC, how much you're spending, whether it's even worth spending, if it's even a profitable channel that you are deploying capital. And also profitability is different than cash flow. I think that's the point there that should be made. So yeah, that's one. If I have to add another one, kind of echoing my point earlier, fundraising, you don't want to wait too long. You want to have the most leverage when you negotiate with an investors. You want to come in, you want to fundraise at a position of strength, if possible. So long enough runway, a story, how do you grow? And then what not to do is don't come to VC when you have 2-3 months left of runway, saying that, hey, I need this money to survive. That would be an absolute no when you pitching a VC.
Yeah, makes a ton of sense. All right, we're almost up on time. So just to close us off, Jason, why don't we go with you first? If you want to share very quickly, what is the one biggest piece of advice you would give people on sort of like cash management and financing? And then how can people reach you and who should reach out to you?
So you can see us at 8fig.co. You can apply for funding right there. We will soon have a pathway for people who don't want to apply for funding, but want to get access to our free cash flow and inventory management tools. And this is not something I mentioned during the talk, but if there is a takeaway, if you don't have a regular forecasting habit, get one and get it in a hurry. Even if you're not great at forecasting day one, which you won't be. Let me save you the suspense. It's going to look a little intimidating, but the importance of having forecasting that you're iteratively getting better at every single week, every single month, is so important in the D2C space. It will make you far more resilient. It will make you far more confident as a founder. And so build good forecasting habits. It's going to save you a lot of grief, and it's going to make you far more in control of your business. So all the stuff I said about, don't make speculative investments with all of your money. Can you start small, get data, and iterate from there? That all ties into forecasting at the end of the day. So get into it. If you don't have a regular forecasting habit, get one. And there are plenty of tools that are out there, including some of the ones that 8fig offers. But that would be my takeaway. Get into a forecasting habit for your brand if you don't have one right now. Even if you do have one, I'm sure there's room for improvement. Evaluate what the tools that are out there. The more accurate your forecasting can be, the more how powerfully positive the decisions you're going to make for your business are. So that would be my takeaway.
Awesome. Daphne.
That was a good one. I like that a lot. So I would second that. So cash flow, I feel like that was it. You hit the nail on the head there. Why don't I give one takeaway in terms of fundraising, financing strategy here? Then make sure when you approach, and maybe again more relevant to me and our fund here, make sure when you approach a VC, you're prepared. Make sure that you've done your homework to know that this person or this fund is a fit for you, and also try to get a warm. You might have heard too. Try to get a warm intro if you can, because it's actually, to me, it's less about who you know, but it's about your ability to network. And because as a founder and CEO, I think it's an important skill. So you need to be able to at least prove to me that you can figure out a way to get to me warmly. I try my best to read and respond to inbound emails, but it's also get overwhelming very easily as well.
This was Daphne's way of saying, don't reach out to me, reach out to Rishabh. And so I am more than happy to be reached out to. But yeah, Daphne, I agree with you. Yeah, and I'll just close this off. Thank you all again for joining us for our second seminar series here at Fermat. You can learn more about us at fermatcommerce.com. We're here to help you drive more effective conversion by having a custom funnel for every piece of content that you deploy on the internet. And thank you, Jason and Daphne, for this wildly educational session. I learned a ton. And honestly, I feel like there's a lot that we're going to be able to help the brands who work with us on. And so thank you both again for taking the time today. All right, everybody. We'll see you in the next one.
Thank you.